Welcome back. Today we will be discussing a new module, decision making under risk and uncertainty. We all know the meaning of decision making and we are familiar with the terms risk as well as uncertainty. In every business there is risk. Risk is inevitable. We can't escape from risk. As far as a businessman is concerned, the main objective of a businessman is to minimize risk, because no one can avoid a risk. Every businessman or every type of business has to face one way or the other type of risk during the course of operation. So from a businessman's point of view, he or she should take necessary steps to minimize risk. And regarding uncertainty is having a relevance in business, because in business not only we are taking decision for running day-to-day activities, we need to take decisions, plans, policies for future also. Future is always uncertain. So as far as a businessman is concerned, uncertainty is of a great deal. So in this module we will be discussing how a businessman has to deal with the situations like risk, uncertainty, and some situation we will use a term certainty. Certainty means which we are means actions or events which will be expected to happen. That is known as certainty, and it will occur for sure. So we'll be dealing with all these situations and how a manager or a decision maker has to select or have to take decision with regard to investments, and what are the methods that has to be followed by a businessman in selecting various opportunities. So before we go into that, let us discuss about the concept of risk and uncertainty. Regarding the meaning of risk, we all know that business is working in an extremely dynamic external environment. It has to suffer different types of risk from different angles. So as far as a businessman is concerned, he has to be well versed with the situations within which he is working. He has to identify what all the type of risk which he has to face and what are the steps that can be taken to avoid and minimize such a risk. So the term risk is derived from a Latin word riscum. Riscum means danger at sea. In the ancient period, the travelers or people usually face risk while taking long distance travels, usually in case of a sea travel. In most cases the sea travels will not be successful. So usually in majority of the cases the sea travel will be a loss or it may be risk. So every time a sea travel is subjected to some sort of risk. So that term is known as riscum. From that riscum the term risk has been originated. So that is the history of that term. Risk refers to the chance that some unfavorable event will occur. Risk generally means possibility of loss. We all know that it means loss. Investor, as far as a business is concerned, invest in securities with the aim of getting returns in future. As the future is uncertain, there are chances of risk. The actual return may vary from the expected return. This variability is known as risk. Risk is the uncertainty of future events. We all know that what is the meaning of risk. Risk may be, we use the term risk in day-to-day activities or in normal life as well as in a business point of view. Risk generally means possibility of loss. But as far as a businessman is concerned, risk means whenever he expects something in return for his investment, and if he receives an amount which is different from what is expected, that difference is known as risk. It may be an amount that is more than is expected or which will be less than is expected. If it is less than his expectations, it is known as risk. So, risk is the probability of failure to accomplish an objective or a goal or a profit or a returns or an income, whatever it is. So, in simple terms, risk is a situation where the outcome is uncertain, and as far as a business point of view, risk is the uncertainty of future events or future returns. Whenever a businessman or an investor expects something, and if there is variability in his returns, that variability is known as risk, especially whenever he receives a return which is less than his expected returns. That variability is known as risk. So, according to Roman, risk is the probability of failure to accomplish an objective, and we have used the term risk colloquially in different situations. As far as a business is concerned, risk is of great importance because there are different types of risk. Because depending upon the business in which a businessman is operating, he has to face different types of risk. In different situations, he has to face different types of risk. So we are going to discuss the different types of risk. Mainly there are two types of risk: systematic risk and unsystematic risk. So let us discuss in detail systematic risk. Then after that we will be dealing with unsystematic risk. A systematic risk is caused by the factors external to the particular business or a company. These factors are uncontrollable. Every business is a part of the economy, and we know that the economy is extremely dynamic. Hence, changes occur in the economic, political, and social systems constantly and vigorously. These changes affect all business and all securities in different forms. For example, economic and political instability adversely affect all industries and companies. A change in government policy may affect the operations of our business. Recession in European countries has affected the entire share market of different countries. Companies as well as investors have no control over systematic risk, because usually in systematic risk the factors will be external. External means beyond the control of the businessman. Means change in the government policies or change in international business policies or any issues in global economy like recession or war or any terrorist attack in any of the developed countries or main countries. Such events are uncontrollable because they are outside the purview of the businessman. Such factors that result in any form of risk to our concern or a businessman is known as systematic risk. Systematic risk is further divided into market risk and purchasing power risk. Let us discuss in detail the concept of market risk. Market risk is an important type of risk. Market prices So the market price of investments or securities fluctuate widely within a short span of time. Change in market price causes change in return from investment. This is known as market risk. Thus, market risk refers to variability in return due to change in market price of investments or assets. The main type of market risk are equity risk, interest rate risk, and currency risk. These are three main types of market risk, and we will discuss in detail each one. Equity risk means the market price of shares varies due to changes in demand and supply of shares. So, equity risk is the risk of loss because of fall in the market price of shares. Whereas interest rate risk is the risk of losing money because of a change in the interest rate. For example, if the interest rate goes up, the market value of the bonds will fall. And finally, currency risk It is a risk of losing money because of a movement in the exchange rate. Usually in the international market, the exchange is mainly based on dollars. So if there is a fall in the value of the dollars, then the investment in foreign exchange market will be a loss as far as a businessman like us is concerned. Next one, purchasing power risk. That is another type of systematic risk. This is the variation in returns due to inflation or loss of purchasing power. We all know the meaning of inflation. So it is a probable loss in the purchasing power of the returns to be received. Every potential risk in price is a risk to the investor. When an investor purchases a security, he forgoes the opportunity to buy some goods or services. It means that he postpones his consumption. Meanwhile, if there is inflation in the economy, the prices of goods and services would increase. Consequently, he has to suffer a fall in the purchasing power of his investment and the return on it. In short, inflation reduces the real rate of returns earned from the investment. This is the purchasing power risk. Purchasing power risk is also known as inflation risk. So a risk which is related with inflation is known as purchasing power risk or inflation risk. Next main category of risk is unsystematic risk. Previously we have learned in detail the concept of systematic risk. Unsystematic risk is just the opposite of systematic risk. The returns from securities may vary because of certain factors affecting only the company issuing such securities. This risk is known as unsystematic risk. It is mainly due to internal factors. These risks are unique or peculiar to a company, such as the managerial inefficiency. It is an internal factor. Technological change in the production process. It is an internal factor. Changes in the consumer preferences. That is related with our business only. And labor turnover, etc. So those internal factors that result in a risk within the organization is known as unsystematic risk. Thus, unsystematic risk is unique or peculiar to a company, which we have mentioned earlier. Since these risks are unique to individual companies or business, they are also known as unique or diversible or asset specific risk. Sometimes a risk may be related with a peculiar asset of a concern. Again, unsystematic risk also is classified into two main categories: business risk and financial risk. Every company operates within a particular operating environment. This operating environment is classified into two: internal environment and external environment. Internal environment refers to the conditions within the company, whereas external environment refers to conditions outside the company. The changes in the operating conditions, that is internal and external, cause a change in the operating profit and returns. The variation in the expected operating profit indicates business risk, whereas a financial risk refers to the variability of profit to equity shareholders due to the debt capital. It is associated with the capital structure of the company. Capital structure of the company consists of equity share capital, preference share capital, debt, long-term loans and short-term loans. The company has to pay a fixed rate of dividend on preference shares and fixed rate of interest on debt. Only the balance of the profit available is provided to the equity shareholders. Thus, the fixed interest payment causes variation in the payment to equity investors. When the rate of earnings of the company is less than the cost of borrowed funds, the return of equity investors would decrease. It is a risk to the equity shareholders. Thus, the variation in the returns of equity investors due to the presence of debt in the capital structure of the company is called financial risk. I hope you are familiar with the term known as financial leverage. Exactly, financial leverage. Every organization might use financial leverage, and the risk arised due to the operation of financial leverage in a concern is known as financial risk. That is the concept. Organization raises capital either from owned funds or borrowed funds. Whenever the organization did not earn sufficient profit so as to provide fixed returns to the outside parties, that will lead to deduction in the returns of the owned capital or owned shareholders. Such a risk is known as financial risk, and it arises due to financial leverage operations. Apart from that, there are other types of risk. First one, default risk or credit risk. We all know that we have to conduct business either for cash or on credit. So whenever the borrower fails to pay the interest and the principal amount within the stipulated time, such risk is called default risk. It is a risk of not getting back the amount that is lent. It is otherwise known as credit risk. Next is the liquidity risk. We all familiar with the term liquidity. Liquidity is the ability of the concerns to repay the short-term obligations. This refers to a situation when the concern or a business is not possible to sell the assets or stock, or it is an inability to meet the liabilities of creditors when they want to withdraw their money. In simple terms, it is the inability of the concerns to repay short-term obligations or to meet the short-term obligation. That is known as liquidity risk. So these are the main types of risk. Apart from that, try to find out different types of other risks that comes under the same category, because there are number of types of risk. These are the major types of risk, and apart from that, try to add more points. We will discuss about how these risks are analyzed and how investment decisions are made after analyzing the risk. We will discuss that part in the next sessions.